Now.
Thank you all for joining us. We appreciate you being here. We are so excited, y'all. We have so much goodness coming up, like Michelle mentioned. I mean, between the events, we're going to be hosting the Chamber After Hours in August here at our offices. We'd love to have y'all here. Wow, this is a big one here. The Awards for Excellence is coming up on February 16th, which is this Sunday, 2 separate times at 4 p.m. and 11 p.m. So make sure to watch it. We had, 15,000 people voting this year, which is crazy. I know, love it, love it, love it. So y'all get to find out who the winners are. So make sure you check that out. Huge, huge thank you to Jennifer and Landmark for being the actual award sponsors. And then all of these others are amazing VIP sponsors. Texas Bank and Trust and Henry and Peter, sorry. So anyway, we couldn't do what we do without all of them. So thank you, thank you, thank you. We've got our shred days now. We were going to call, what are we calling them? Secure your ID
They're
days?
technically, yeah, it's a lot of words, so we just call it.
Pretty much a shred day, you know. So our first one is coming up. I was actually out in Panola County yesterday in the rain, but it was a wonderful time. We got to be involved in the proclamation there with the Commissioner's Court, which was awesome. This is their, March 1st is their annual Panola County Cleanup Day, and we figured, why don't we just partner with them and have our trucks there to do the shredding also. So again, thank you so, so much to our VIP sponsors on that. So very important. Like I said, that one's coming up, and then the Tyler one is huge. Normally we do it the first Saturday after tax day, but being that that's Easter weekend, we pushed it to the following weekend. So that is April 26th here at our offices. We want to thank Kelly Community, who is the actual sponsor there as well, along with all of the VIPs, again, that we could not do anything, we could not do what we do without them. So, and Arklatex just always does such an amazing job.
You want to tell everybody what a VIP is, since they
yes,
may
the
not know.
VIP investor package is basically, I love it because it's your one-stop shop, everything, you're everywhere at all times that the BBB is, all events. It's basically, instead of picking and choosing what sponsorship levels you want to take, it pretty much gets you
Everything.
everything. So it's great, and it's at a severely discounted rate, y'all. It's about $20,000 worth of marketing for 10 grand. So it's just substantially discounted, and I love it because, again, your brand, no matter where we're at, billboards, I mean, everywhere, that brand is there alongside ours. So, yes, I'll follow up with y'all in an email with all the details and all that good stuff to make it easy for y'all. I'm all about making it easy. Our next month one is going to be the 5 keys to building high-performing teams, which is so very important. Oh, my goodness. Like I said, Amy, she's a pretty newly accredited business, right? And that's what we try to do, of course, is to work with, of course, the ones that have been with us for a long time, but then also give opportunities to the newly accredited businesses as well for their voice to be heard and them to get
She's
their
got a great
expertise.
resume,
That's
so
awesome.
yeah.
Awesome. Looking forward to that big time on that one. This is the fun one. This is the one that's coming up the quickest. Like I said, virtual trivia. We already have, I think, like 12 teams signed up. How many can we hold, Michelle?
As many as we want, yeah. We do it this way because we cover 19 counties, and this is one way that everybody in every county can participate.
Yes.
It's virtual. It was super fun last year.
Yes. And she's hired a professional to
Yeah.
do it, so he knows.
I'm not doing it.
So it runs smoothly, and
Yeah.
I mean, everybody had a great time. There's huge door prizes and stuff like that. So it's just some great team building.
It's great. Yeah, it's a great thing for your team to do as a team building activity, and you don't have to leave your office. And it's $100 per team. It's not very
And
much.
it's a
So,
great way for your brand to be represented as well. That's so important. You know?
Battle of
So,
the Businesses.
Yes, and thanks again to our awesome VIPs and sponsors for that as well. The sponsors are bomb.com, Austin Bank in the house over here.
Yeah.
Love it. Yay! So today, what I really wanted to not only just introduce, but we also need to give a huge shout out to East Texas Auto Rentals. They sponsored today's Lunch.Learn.Lead luncheon. That's also an option as well. Each luncheon, the sponsorship is $500 to sponsor, and that goes towards, of course, helping pay for the food and all of that good stuff. So that's a great, wonderful opportunity as well for y'all to get your brand out there and to support. So just want to give them an extra shout out, as well as, of course, all of our VIPs again. So let's see here. Boom, boom, boom. This time biz. Okay, so let me do the intro. I'm so excited. I'm gonna read it fast. Miss Lynn Song is the tax manager. She's been with Gollob. She moved from Southern California to East Texas in 2003. She quotes, "I love the piney woods, but I miss the beach." I'm a beach person.
Me too.
Yes. Lynn is married to her husband Manny, with whom she shares 2 sons, as well as their golden doodle Timber. What a cute name. Growing up, Lynn wanted to be 3 things. All 3 started with the letter A: attorney, architect, and/or accountant. I love it. I love it. Lynn says accountant made the most sense. Yes, pun intended, but true nonetheless. I love it. I love it. Lynn attended UT Tyler, earning her BA in accounting in 2015 and MA, that's master's, right? MACC, you see, I didn't go to college. So in 2017, in the fall of 2014, Lynn volunteered at the Tal Glen Memorial Golf Tournament, where she met Chris Gusa. That's a partner, right? Yeah. Who offered her an internship. Lynn comments, "She must have liked me because I was offered an internship the following spring. I have been with Gollob Morgan Peddy ever since." So awesome. Some of her hobbies consist of gardening, needlepoint, and crocheting, knitting. She is also delving into quilting, while also enjoying hiking, cycling, and reading a good book. I love it. And then Mr. Greg Parker, partner. I love it. Greg Parker is a CPA and now a partner at Gollob Morgan Peddy and Tyler. Congratulations. Seriously, that is so amazing. His practice areas include real estate, oil and gas, and tax planning for corporations, partnerships, and high net worth individuals, while also playing an active role in helping to keep the firm and its clients up to date with frequently changing tax laws and regulations. So important. Being a native East Texan, Greg has grown up in Palestine before moving to Tyler to finish up high school and get a business degree in accounting from UT Tyler. After graduating in 2011, Greg began his career in public accounting at Gollob Morgan Peddy. Greg was named partner in January 2025. I'm so happy for you. He currently lives in White House, where his wife Sarah teaches kindergarten. Aww. Sarah and Greg have 2 children, Grayson, one of my grandson's names, love that name, and Eden.
Siri is always listening.
In his free time, Greg enjoys spending time hanging out or traveling with his family, but also loves running and rooting for the Dallas. I always thought, I do see Cowboys on there. Dallas Mavericks and Dallas Cowboys. Poor us, right? Thank y'all so much for being here. Come on up. I was serious. You got the clicker? Can I give you the clicker? No extra sugar. It was just right here. Here it is. I'm so sorry. Boom, you're ready. I was hiding it from you.
Thank y'all for having us. It's always honor to know that you guys. This one?
Yeah, Lynn. Trying to get Lynn in the shot and your slides. Yeah, there you go.
I don't know if you want me in there or not.
Of course we do.
It's always honor to know that you guys haven't suffered enough and you want us to come back again every year and talk about taxes for you guys. Especially you, Jace. I feel bad that you're going to have to sit through this. But we'll try our best to make it somewhat entertaining. Hopefully by the end of this, you at least have enough knowledge to, impress your accountant or maybe annoy him. I don't know, but we'll get you there. But there's not, the thing about this year is there hasn't been as much change to the tax law from last year's update to this one. So we some of the stuff you'll see might look familiar from last year, but we try to change it up here a little bit here and there. But coming up this next year, I'm sure we'll have plenty to talk about after whatever happens with the tax law actually gets put in place. And at the end of the presentation, we'll talk a little bit about what the Trump administration has said they want to do and kind of some of the speculation of what might happen. But obviously, we don't know until it actually does. So I'm going to be doing a little bit at the beginning of it. I'm going to do a business, go over some business topics. Then Lynn's going to start taking over with some of the individual tax updates and some of the more current bills that were passed, and then at the end, like I said, we'll talk a little bit about potential upcoming changes. So, the Work Opportunity Tax Credit. Show of hands if anyone's heard of this or used it. Okay. You're good. So this might be work on time to talk about. So the reason we put this one on here is because it's actually coming to an end at the end of 2025. So you have a little bit more time to take advantage of it if it's something that makes sense for your business. Essentially, it's basically a way the government is incentivizing businesses to hire people who might otherwise have a hard time getting a job. So we'll go through the categories of different people that are eligible for this credit on the next slide. But really, the way it works is if you hire someone from certain groups, such as veterans or people receiving government assistance, I think ex-felons is one of the groups on there, you might be eligible for this credit. And so the way it works is if you are going to be hiring somebody like that, you fill out a form. You have to send it in to the Texas Workforce Commission within 28 days, I think, of when you hire them. They will approve it. They'll basically go through and make sure that this person does qualify for it. Then they'll let you know, and then you start calculating the credit, and you will get a credit on your income tax return for it. If nonprofits are also eligible to do it, since they don't have income tax returns that they file, they will get their credit back through Social Security withholdings that their employees might have had. So it's a way you can save money on taxes, and it's also a way you can help people having trouble finding a job. So it's something wanted to mention. The important things to remember about it are that 28-day rule. If you're going to take advantage of it, you only have so much time to get that form in. The credit can be anywhere from $2,400 to $9,600 per hire that you do. I'm not going to go into all the details about how the calculation works for it, but just know that it's something out there, and we have quite a bit of clients that actually take advantage of it, and it can add up and be significant. Another thing I should have mentioned at the beginning, if you guys have questions at any point in this, you don't have to wait until the end. You can just raise your hand.
So even on the highest credit at 40%, that's 22,000. So that these are like low-paying jobs, right?
Typically, it probably will be. You're basically going to get a credit of 40% of your wages up until you reach these maximum credits. So per employee, it's going to be either $2,400 or up to $9,600. And so, if you have 10 veterans that qualify, there's different levels of the veterans, like how long they've been unemployed and different stuff like that. But some of them can get a credit up to $9,600. If you have like 4 of those, that can be a lot of money and worth the time to look at. And so this is the list of potential recipients of it: veterans, SNAP recipients, ex-felons, supplementary security income recipients, long-term unemployment recipients. So there's quite different ones. And so if you think you hire individuals in this group already, then it's obviously a good idea to at least take advantage of this. So that's just something.
Long-term is defined as?
That's a good question. I'm not sure how long it
Is
is.
it 3 months, 6 months, a year?
I don't know. I'm not sure. Let's see. Does anyone have any more questions on the work opportunity tax credit?
I've seen it a lot with like my big restaurant groups in this area. They tend to have this credit.
So if you didn't know about this credit, and let's say you have veterans on your staff, is it too late to?
Probably it's too late. It's only you have to within 28 days of hiring.
Okay.
So it used to work. There used to be an older version of this where it kind of worked like that, where you could go back and do it. But they really wanted this one to be built in a way that incentivized you to make new hires for this credit.
Makes sense.
So employee retention credit. I feel like I've been talking about this for 10 years, but raise your hand if you've heard of the employee retention credit. Has anyone actually used it and gotten it? I for their business? Okay, so people. So basically during COVID, after COVID, this was something that the government came up with to basically reward employers for keeping their employees during COVID, even when there were shutdowns and different things like this. So if you had employees and your business was being impacted negatively by COVID, then you could potentially get this credit. And so it's been going on. So this now you're going to be looking back at your 2020 and 2021 tax year. You can't do 2020 anymore. That deadline is finally passed. But you can still look at your 2021 tax year and take advantage of the credit potentially. And so we'll talk a little bit about how it works. So it's basically you can get up to $7,000 per employee for each quarter, potentially. But first we have to figure out if you qualify to even get this credit. And so to qualify, there's two different ways that you can qualify. You can either have you can claim that your business was basically shut down for those for time during the first 3 quarters of 2021, and you can say like your supply chain was messed up, you couldn't travel to go to group meetings and different things like that. And the other way is kind of an actual test of numbers, and if you meet the second test of numbers, you don't really have to worry about anything else. You qualify. And so if basically your gross receipts were declined in 20% from, say, we're looking at the first quarter in 2021, and we compare it to 2019 before COVID hit. If we had a decline in gross receipts of 20% or more, then you qualify for that credit for that quarter. And you look at the first 3 quarters of 2021 and see if you did it. I would not recommend, unless you meet that gross receipts test, that you would go forward and seek out this credit, because the IRS has really been cracking down on people for trying to basically say, yeah, there was a COVID shutdown, but around here, unless you're a restaurant or a few different other types of businesses, it really didn't impact as bad as some of the other parts of the country. And so some people are saying, yeah, my gross receipts, even though my gross receipts are up in 2021, I was impacted and still try to take the credit. And the IRS is really kind of going after some of that, and they've paused some of the processing of the returns and stuff like that for it. So I would say, look at your gross receipts compared to 2019 to 2021. If you can do it, then you still have until April 15th to get this credit. And it can be significant if you have a lot of employees, because like I said, up to $7,000 per employee. If you have 10 employees, that's $70,000 for that quarter. And so it can be significant. We've had clients that get them with hundreds of thousands of dollars on their employee retention credits before. So. The moratorium, this is kind of what I was talking about, that where the IRS, they put a pause on you sending in and then processing these ERC claims. And the reason was because there were so many bad actors taking advantage of it, and they were realizing we got to stop and look at these closer. And so we need more time. So they stopped completely processing some of the claims that were filed from September 2023 through January 2024. They finally started processing those again. You can now, claims submitted after January 31st, 2024 are still in a moratorium. You can send them in, but we don't know when they're going to start processing them again. There's over 1.2 million claims that are backlogged, and they are saying that the delays are going to extend into 2026, and knowing the IRS is probably actually a little bit longer than that, because they always say, say it a little sooner than it really is. Anybody have questions on that? Okay. All right. So depreciation. So first of all, what is depreciation? If you buy a fixed asset such as equipment, machinery, equipment, furniture, or something like that in your business, you can take a deduction for it. You can depreciate it, is what we call it. And there's the default that you would do. You're going to say you buy equipment, you're going to depreciate and take a deduction over 5 years for that thing. So if your equipment was $5,000, it's going to take us 5 years to get that full $5,000 deduction, unless we elect to do it a couple different ways on the tax return, which we usually do if we can. One of them is called bonus depreciation, and up till 2022, we we could take 100% bonus depreciation, meaning if you bought an asset in 2022 and it was equipment, we could depreciate and take an expense for the full cost of that in that first year that you did it. But that was part of the Tax Cuts and Jobs Act that happened in 2018, I think it was, or when it was, and so 17. And so part of that, to get that bill to work, they had to get that 100% bonus depreciation to go away over time. And so starting in 2023, you could only take 80% in the first year. 2024, the tax returns that we're working on right now, you can only take 60% in the first year, and so forth. It's going to be 40% for 2025, 20% for 2026, and then after that, it's going to be actually gone. Bonus depreciation here is actually gone. So, having said all that, there is another option, as the IRS makes sure everything's as complicated as possible, but we have another option to depreciate things. It's called Section 179. So if you are buying new equipment or something this year, and you have a tax accountant doing it, you need to make sure that they're considering the Section 179, because a lot of accountants got out of the habit of going through, there's different rules to take Section 179, and a lot of accountants got out of the habit of having to do it because it was easy just to take bonus depreciation, because we could just take that on a lot of stuff and not have to worry about doing anything else. But you can still depreciate 100% potentially of some of your stuff. If you take Section 179, there's a lot of rules and stuff that go along with that. Just want you to be aware of it, and if you have an accountant working on your stuff, to make sure that they are taking that into consideration. One thing about Section 179, you can't create a net loss on your tax return with it. With bonus depreciation, you could, but Section 179, you cannot. So you can only reduce your income down to zero with it, and if you take more than that, then it gets carried forward to the future year. Real quick on this, LLCs electing S Corp status. There's an issue that's kind of becoming more common and more looked at by the IRS, to where, say you started as an LLC and you got your operating agreement done. A lot of times when attorneys are going to do those operating agreements, they set up the LLC ones with a lot of language in there as if it's a partnership. So if you're going to switch and be treated like an S corporation, there are certain rules having to do with distributions and the types of stock that you have in there, that there needs to be very specific language in your operating agreement to support that, because the IRS would like to come in if you have an S corporation, and if they're going to look at it, they're going to ask to see your operating agreement. If it doesn't have these things that they're looking at in there, they're going to say, well, this violates this, this, and this. Doesn't look like you actually have an S corp. We're going to go back and say it's this, and then you're going to have all these distributions that you took that weren't subject to self-employment tax. Suddenly they are. There's a long list of things. So basically, what I want you to get from this is, if you have an S corp, make sure that you go to an attorney and get your operating agreement done, and make sure they're doing it in the way that needs to be done for an S corporation. And any good attorney that sets up legal agreements for business entities will know how to do it and know what you're talking about when you do it. But I've been a part of where someone was trying to sell their company to a big company, and the first thing the big company did was ask for the operating agreement, because they knew they were buying an S corporation, and it's so common that it's messed up in there. They look and make sure that that's correct, because they know that they don't want to deal with the IRS on it, and that kind of blew up the whole deal for this client that they were trying to sell it to, because they were like, your operating agreement's not right, too much risk, we don't want to do it anymore. So it's important to look at that. Okay. Has anyone heard of the Corporate Transparency Act and the beneficial ownership information reports that we're going to need? Okay. That's kind of the thing y'all can say yes. Let's see. So in 2020, I don't remember when the rule came out, but there's going to be new reporting required starting in 2024 originally. We're going to talk about the original rules real quick, and then we'll talk about where we are right now with them, because like everything else that's been changing. So it's basically reporting that the government is wanting you to do to provide information on who the owners are in your business, so that if they need to, they can even use that information to track down criminals that are trying to, launder money or do something in their businesses. So now if they have information on the owners of every business, they think they might be able to use that data to help them in fighting that type of crime, because that's what they say that their purpose is for. Whether it's going to be beneficial for them to do that, who knows, but that's the purpose of this. And so any company basically that you got set up with the Secretary of State in Texas, so an LLC, a corporation, an LLP, basically anything other than like a trust, if you have it set up, you're going to be subject to these reporting requirements. And so there's some exemptions for it, but it's going to be for large operating companies. So if you don't make over more than $5 million of gross receipts in a year, or you don't have more than 20 employees, then most likely you're going to be subject to this. So, but if you do have over 5 million of gross receipts and over 20 employees, you're considered a large operating company, and you're exempt from this.
Is it or and or?
Both.
You have to have both.
Both. Yes.
If you have more than 5 million but only 5 employees, then you don't have to do it.
No, so if you have more than 5 million and only 5 employees, you do have to do it. This gets you out of it. If you meet both of those requirements, then you're considered a large operating company and you're exempt from it. Non-profit entities are not part of it. Then there's some other specific ones like banks and insurance companies and registered investment advisors that get a specific thing, and the reason they do is because they're already providing a lot of this information through other different requirements the government is, so they already kind of have some of their information. Right?
Do you have to do it more than once, or when you fill out the paperwork, do you have to do it every year, or is it just a one time?
That's a good question. So it's just the one time until something changes.
Okay.
So if you have an owner change, or you moved your address changes, your personal address changes or something like that, then technically you're supposed to go back on there, and I think you have 30 days or something after that happens to go back and update it.
Okay, you said personal address. What if the business address
Business
changes?
address would be something that you would
Also-
need to update it for as well.
Thank you.
Yes.
In non-operating holding companies, LLCs, or have this requirement?
Yep, correct. Yep, any LLC.
But on the FinCEN website, they'll have some instructions for the BOI, and there are a list to show you if you meet the exception. So it's helpful if you just go on the website to
Right.
see that.
In our experience, most of the companies that we do stuff for and they wanted help with it, they did not get there. We had some where we found an exemption for them, but I would say 95% of them had to do it if they wanted to do it.
I think there's also a rule if you're an inactive LLC, inactive business, and again, I'm not quite familiar with what that means with inactive, like within the last 5 years or something.
Mhm.
If there's no activity, then you would have to follow as well. But again, it's on that exception.
Right. And so basically what you're having to report in the long run, and this is the detailed information on it, if you want to pull up the slides and look at it, but it's basically going to be information about the address and stuff of the company, and then also the owners that own more than 25% of it, and anybody who actually exercises like control over the entity. So if you have like a CFO or COO or something like that, even though they don't own it, if they're making decisions and they can control kind of what the company does, you're supposed to include them on it. And if you include them on it, then you're going to basically give their name, address, social security number, and then the annoying part is you have to have a copy of their driver's license or some other identifying thing. You have to make a copy of that and provide that as part of the report. And so that is usually the part that pulls up. You're trying to get all these people's driver's license and copies of it. So it's kind of that can be a thing. And so if your driver's license changes the address that shows up on there, or you have to get it renewed or something, that could be something that you need to update the thing for. And so
I actually have to stop one filing just to wait for the client to give me his new address because he moved, and the driver's license, it had to change, so we had to just wait on that, and we were coming up to the deadline.
Yeah.
So that was stressful.
Yeah. And so the timeline, this is the original timeline that we had. So if you had an existing entity that was formed prior to January 1, 2024, you were gonna have to have this done by basically December 31st of 2025. I'm about to go into why, I keep saying this is what the original was. There was court cases that came up that got a lot of this suspended for now, and we'll talk about that in a second. But then if you had a company basically that was started in 2024, they would give you 90 days to complete this report after the entity was done. And going forward, it's going to be if you create a company, you're going to have 30 days from which you receive notice that its creation is effective to get this report done. So if you start a new LLC now, you're going to have 30 days to do this. There are penalties. The size of the penalties to me is crazy for what we're talking about. It's a daily $500 fine for failing to report or providing false information, and it goes up to a maximum of $10,000. And so whether they're going to, how strict they're going to be on this and stuff, who knows? But this is what they are saying they can do penalty-wise. I don't personally know if they're going to go after every single person for it, because when we come up to the deadline on December, like I think there was millions of businesses that had not done it yet. So I don't know what they were planning to do at that point or do it, but
Something else to note when you go up to put the report, when you go to report it on the FinCEN website, nowhere on the report does it actually say when was your entity created.
right.
So technically,
Have it.
yeah, I didn't say that.
All right. What happened though was there were some court cases that came up. Both of them happened to be in Texas, that where the judge ruled that these were not this requirement was not constitutional, and so they put an injunction on it, which basically means the requirement to do this is suspended, and that's where we're actually sitting at right now. We did a bunch of them for clients. This happened in I think it was December or when this injunction got put in place. So we had been doing them for clients all year, and then it got suspended. And so there's no penalties that apply for non-compliance while these injunctions are active. And so you can see for all the different, dates that your company was made, it's suspended right now, the current status of it. But recently, the Treasury has put in an appeal. One of these cases, they've already got a stay put on the injunction, so that one's not holding things up anymore. But then there's this Smith versus U.S. Treasury is the one that's still holding it up. The Treasury has put in an appeal for that. They said if they get the stay put on that, they are going to put it back into effect. They're going to give everybody 30 days is what they mentioned to do it. But they did also mention that they are going to try to prioritize high-risk entities, whatever that means. They haven't defined what that means, and maybe make the penalties less severe for the majority of people. So if they're going to do that, they're going to have to basically redo some of the BOI rules. We don't know what they're going to do that. I don't really know how they're going to determine what is a high risk or not. But just know, basically, our advice is just kind of know that this is out there. If you haven't done it or not, you can voluntarily file it. If you just don't want to have to worry about it anymore, you can go ahead and do it. You can still voluntarily file it. Maybe if you don't want to and you're waiting to see how it works out, just keep an eye on the news about it. Maybe gather the stuff you need so you're ready to go when it goes, but just want to make sure everybody's aware of that. Any questions on that?
Okay, well, it's my turn. So I wore my lovely heart today to honor your love and we're going to start with the tax bracket. So this is the 24 tax bracket. Now I'd like to go find where you are I love where I'm at, but I'm not. I don't love it either, double-edged sword, right? Because you're paying, wherever your bracket is, you could be going, oh, I'm paying less taxes, but I don't have the income either, that's why. Okay, so 25. Okay, so not that much change, and I'll read you some of the changes, okay, for mainly the married filing joint. It went up $650 for the 10% bracket, 12% went up $26.50, 22 is $56.50, 24% is $10,700, 32% is $13,600, and 35% it went up $20,400. So if your income can go up and you'll still be within that bracket. Okay, this is the long-term capital gain. If you sold stocks that you held for over a year, this would apply to you. It would not, you wouldn't pay your ordinary bracket tax rate. You would pay the lower capital gain tax rate. So for example, if you sold Apple stocks and that you made a $10,000 gain on that Apple stock, well then if your income for married filing joint is within the 94 to 500,000, then you're only going to be paying 15% on the long-term capital gain. Does that make sense? Okay. Yeah, we're going to go fast. Yeah. So that was 24. Is this 20? This is 25. Okay. So again, not that much change. We're talking about, let's see, so if you're at that 15% tax bracket, to get over to the next 20, for single, you're up $14,500, married filing joint is $16,750, married filing separately, slightly half of married filing joint, which is $81.50, and head of household is $15,350. Just a little bit more, still fit in that bracket. Hey, standard deduction. Standard deduction went up for married filing separately and single about $400. Your married filing joint is $800, and a head of household is $600. So about 90% of taxpayers take the standard deduction.
I understand the married filing joint and single or what have you, but what is head of household?
Head of household is, say for instance, you're single but you have dependents.
I got you.
Okay, so the annual gift tax exclusion went up to $19,000. So we usually get a lot of questions on this one. When you give a gift of in excess of $19,000, then you would have. Right?
You're generous.
And we're not talking about donations. We're talking about
Yes.
a cash gift to a non-profit, to an individual, and if you gave more than the $19,000 exclusion, then you would have a gift tax reporting that you would need to do. Okay? But it's not a true tax, it's more informational return. So, because it uses up your lifetime exemption for your estate. So your lifetime exemption for your estate now for 2025 is almost $14 million. So that is supposed to sunset the end of this year, and it'll go back down to with the inflation and everything adjusted, about $7 million. So if you are worth more than the $14 million here, please go talk to your attorney and be my friend. Okay. Okay.
But next year, you don't want them to be your friend because You'll only be worth 7 million.
You can always be friends, even if you only work
Only
less
worth
than a million. It just depends, if you give me less
Yeah.
than 19, I will still love you. Then that way you wouldn't have the obligation to file it. So child tax credit, it hasn't changed, is you'll get the 2,000 credit per qualifying child. Qualifying child is child, but they're under 17. If they're over 17, they're living with you, then they qualify as a dependent. And so you'll still get a $500 credit for a dependent. So that would be me. I have a 18-year-old, so he's my dependent. Educator deduction still at 300, has not changed. It won't change in 2025 either. Okay. IRA contributions. For 2025 and 2024, it was 7,000, has not changed. If you're over 50, you can make an additional 1,000 catch up, so you're at 8,000 for the IRA contributions. 401k went up 500 in 2025, so 23,500 for 2025. Again, if you are age 50 and over, you get an additional 7,500 catch up. But here's the one little kind of, if you're age 60 to 63, you get to add 11,250 as your catch up. But only if you're in between those age. So the maximum that you could actually do if you're between 60 and 63 is 34,700. But only if you're in that. Okay.
How did I come up with that?
Right? And why couldn't they just do a nice round number like 12,000? Who knows? It's the IRS.
63.
Maybe they said an extra 50 helped them to reduce this much in taxes. We were just talking about that. Yeah, we were good. Okay, so required minimum distribution, this changed. It used to be like what, at 70 and a half, you had to take it, and now it's at 73. Right, and then they also changed this provision where if you had a spouse, and I put an example here, and your spouse was, the spouse was younger, and you predeceased your spouse, then the spouse could elect to use their age for the required minimum distribution. Or vice versa, if you were the younger spouse and you predeceased, and it was your IRA that went to your spouse, then they could elect to use your age to determine when the required minimum distribution is. Does that make sense? Okay. Okay, I think we're good on that. All right.
Question on RMDs,
Okay.
because it pertains to Ken, it's not.
I know, Brad, like, why are you here?
Yeah, so, did they come up with guidance on if someone died after their RMD started, the beneficiary, is it like revert like to the old stretch style RMD, or how did they, because I know they came out with clarification
Like as
on
an
that.
inheritance IRA?
Yeah, so they inherited it,
Mhm.
and it's passed down to them.
Okay,
The decedent has already started their RMD
right.
before they passed. Is the guidance on that going to be more of they could have to continue to take that RMD and then still fit in that 10-year window? Because I've heard a lot
I
of.
think the 10-year window is really for if you inherit it as a non-spouse.
Right, and this is going to be as a non-spouse too.
Right, so as a non-spouse, it would be over the 10 year.
I think they talked a lot about changing it, but as far as I know, I think it's still that 10-year
Yeah.
period.
I believe it's a 10
But you don't have to continue the RMD that from the decedent? Because that was where the catch was, is I know the 10 years still stays,
Okay,
but the RMD, you have to continue that RMD that the decedent already started.
I think it all, I'm not sure about the RMD, but I want to say that it should all be distributed in 10 years.
Right.
So whether you choose that R&D amount.
Right, and that's how we've been doing it, is like you could
You can pick,
do it all at 10 years,
Right.
10th year.
Right.
But
That's from my
They're now-
understanding is that you could, it just needs to be distributed all over.
because they're now telling us that if the R&D started, you gotta continue.
Can you,
that.
is that right? So I'd have to look that up.
Yeah, so,
Yeah.
I'll send you an email, how about
I-
that?
yes.
Yeah, so
You
I'll-
owe me an email.
Yeah, I do.
Okay. But from what I gathered, it was just that it needed to be distributed, but no, I haven't heard anything about the R&D
Okay.
portion.
Perfect.
Okay. We were, yeah, the 529. So do you guys have any young kids who you're putting money towards their 529? So it used to be where what happens if you had all this money in the 529 plan and either they didn't go to school, you didn't use up all of the funds for qualifying education, you don't have anyone else to pass it down to. Well, now they allow you to roll this over into a Roth IRA.
Oh,
What do you mean?
no, I just said, oh.
Yeah. So,
You don't have to give it to your kids, which is what my kids are hoping for.
No, yeah.
So there's a little bit of a caveat in here, right? I want to put it in my name,
Yeah.
and then I want to be able to like put it. If I didn't use it for my kids, I'm just going to use it for. But you only get it put up to 35,000. Okay, and it still needs to fit within the IRA contribution annual limit. So the annual limit is 7,000. So if you roll this over, you can only roll over 7,000 per year, and the maximum is 35,000 that you can roll over. Okay. So, but that's still a nice benefit, right? Oh, and the other caveat is, if assuming that you did have this in your child's name and you rolled it over to your child's Roth IRA, they would still need earned income in order to contribute to any IRA, right? So just take that into account.
One more thing that's on there. So basically, if you put money in the last 5 years before you decide to move this to a Roth IRA, they don't let you move that amount over because they think people will take advantage that can't do a Roth IRA or something and start at 529 and just put it in there and then just move it over to get it in there. And so those last 5 years, so that you have the 529 plan, the amounts you put in don't count.
So just hold it for another
Yeah.
15, and then roll it over.
Yep.
Okay. And then back to Greg. Yeah.
Okay.
Not much change.
Alright. So, now we're going to talk a little bit about the future tax outlook. So, wait, this might still be you. Is that you?
No.
Oh, okay.
Well, unless you want to just talk about the.
Yeah, so
credit vehicle.
inflation reduction, I did not, okay.
I have
Let's see. So there were a lot of things in this Inflation Reduction Act that had to do with clean energy or electric vehicles, and they came out with a lot of different credits that were available for it. So clean vehicles, there's a credit available up to $7,500 for qualifying electric or plug-in vehicles that were placed in service after January 1st, 2023. It's got to be so if it's placed in service after January 1st, 2023, a traditional hybrid that does not plug in does not qualify. Did you get credit on yours? I saw you driving up in the Tesla.
The Cybertruck?
Yeah,
That's what I was gonna ask you. I was gonna ask you about that,
Yeah.
because the manufacturer's suggested retail price, is that like the base price? And then if you add stuff to it, then if you go over 80,000, then you're not qualified? Or is it, what part of the MSRP?
I think if you go over 80,000 with the add-ons and stuff, you will not be qualified for it. I know that like when they
You're not
changed-
qualified.
Okay. About that. Then I know that Tesla changed some of the prices of like the lower end ones so that they could still kind of fall into these and people could still get
I
the
think
credit.
that's one of the reasons why people are not doing the full self-driving, then adding on that, an
Yeah.
additional 8,000-9,000 is so they can still stay under the MSRP.
Let's see. Residential clean energy, so if there's a lot of new credits that they put in here for improvements to your residence that you can take advantage of either deductions or credits on. So you might be able to take a credit up to 30% of the cost of some of these qualified energy efficient improvements. The ones that we see a lot are like a special type of insulation that you can put into a house that makes it more energy efficient. Exterior windows and doors that were made to keep the house better insulated. Sometimes we see solar panels that have some credits with it.
Air conditioning.
Yeah, furnaces, water heaters, and different ones that meet certain energy efficiency requirements. Usually, if you're buying one of these, they're going to probably advertise it as potentially eligible for these credits, and they're going to use that as like a selling point on it, so you probably know about it from that way. But a lot of them like on the tax credit. There's always a limit, yes.
Should this be called the Green New Deal?
It's part of it, all this stuff is related to it, and what we're going to talk about in a second with the future outlook. I may be telling you all this, and then it's gone next year, so we'll see on that part. So it's basically 30% of the cost of a lot of them. They're different percentages based on the different categories of it. Research and development expenses. So prior to 2022, if you had research and experimental expenses, they were fully deductible, but in 2022, a new rule came in that said you had to amortize those over either a 5-year or 15-year period, depending on whether it's domestic or foreign. So I don't know if a lot this is going to apply a lot. It's usually for companies that are into some sort of software or maybe manufacturing or something where they are doing research and development on their product of some sort. And there's a credit that goes along with it. And you see, you could do the credit, but you could also take these expenses for the actual expenses that you had. Now you can still do the credit, but you can't take that expense in the first year. You have to amortize it over however long.
And usually with this type of research and developmental credit, what we usually see is, or what's provided to us is an actual report from a third party that shows here's the credit and this is what you're allowed to take. So some of my clients, they are opting out of doing that credit because that's an extra report that they would have to pay for, but they're not able to really utilize or the deduction because they have to be amortized.
Okay. So what's not in Secure 2.0? So Secure 2.0 is an act that came out that had a lot to do with retirement plans and made a lot of changes to the rules. That's the one that came in and made it for the required minimum distributions. It switched it from 70.5 to 73. There's a lot of rules in there, and so this is kind of covering stuff that didn't change in there. There's no elimination of or the restriction on the backdoor Roth IRAs, and this is when you have a basis in your traditional IRA. There is a mechanism, a way you can go about transferring some of that over to a Roth IRA when you have a non-deductible traditional IRA contribution. It's kind of a loophole, and they did not get rid of it. People thought that they were going to, they did. So there's they didn't put restrictions on Roth conversions for the high-income taxpayers. It didn't increase R&Ds for high-income taxpayers. No changes to the age where qualified charitable contributions from an IRA can be made. So once you reach 70.5, you can make qualified charitable distributions from your IRA, and what that means is you can say, hey, I want $5,000 of my distribution from my IRA to go straight to this nonprofit. And by doing that, you do not have to pick up that $5,000 of income on your income tax return. And so that's beneficial because a lot of people take the standard deduction now and they don't get benefit from their charitable contributions. And so this is a way that you can get benefit from it. If you're going to be making that charitable contribution anyways and you're over 70 and a half, you should look into making some of these qualified charitable distributions from your IRA. No clarification of how the 10-year rule applies to a person who inherits a retirement account and is not an eligible designated beneficiary. And no change to the step-up provisions on inheritances. And that, just the step-up provision means when you inherit property, you get to step up your basis in that property at the date of death of the person that you inherited from. So if you got a house from your mom when she passed away, your basis in it would be the value that it was when she died. So that when if you were to sell it, you're not picking up gain on the value she had when she first bought it. So there's a big gap there. So that did not go away. Okay, make it through those even though it's not. Great. All right. So you may have questions on that? Okay. So future tax outlook. There was something called the Tax Cuts and Jobs Act. This up here is written as TCJA. And it had a lot of provisions that changed the tax code and made, what we're working with right now. But to make the bill work for the budget, they had to set a lot of these to expire. And there's a ton of these that are going to expire as of December 31st, 2025. And major provisions. And so we'll go over some of those. One of them is the standard deduction that Lane went over. What was it? Getting up to 30,000.
15
And so those were increased significantly with the Tax Cuts and Jobs Act. If once it expires, those are probably going to be cut about in half. And so, like, if we were talking about $30,000, it'll be about $15,000 for married filing joint when it expires. There used to be something called a personal exemption that you would get depending on your income of like, if it was $3,000, those went away when they increased the standard deduction. When this stuff expires, that will come back. Individual income tax rates. The marginal tax rates are going to go back to the pre-2017 levels. So really, the biggest change there, the brackets kind of change back and forth, but the biggest thing is that top rate is going to go back to where it used to be at 39.6 instead of what it is right now at 37.
That's for 2026, right?
2026, yes, sir.
Unless they change it now.
Unless they change it now, we're going to get to that. Yeah. And so state and local tax deduction. Right now, they put a $10,000 cap on how much you can deduct on Schedule A for your state and local taxes, which is basically your property taxes and your sales tax that you pay during the year. If you have state income tax returns that you file, that state income tax also goes into this number. You add all those together and say you have $12,000 worth of it. Right now you can only deduct $10,000 and another $2,000 just goes deducted to use it. That was put in with the Tax Cuts and Jobs Act. That would be removed if they don't make any changes to it and go away. So you can deduct all of your taxes on Schedule A if you itemize. The child tax credit that Lynn was talking about being $2,000 per qualified child would go back down to what it used to be of $1,000 per child under 17. This is a big one, the qualified business income deduction. Right now, basically, most businesses that are pass-through entities like an S-corp, a partnership, or even a sole proprietorship, you get a 20% deduction on your net income, subject to some limits. So this is a big deduction that a lot of companies get. That when this goes away, they're going to notice a big increase in their tax. They might not know why, but if this goes away, this will be significant. So it's a 20% deduction that you just kind of get just because they put it in this tax code. And that is set to go away. And then Lynn mentioned the state tax exemption being almost 14 million. It's going to go back down to 5 million adjusted for inflation, which they say will be around $7 million. Now, having said all that, Trump proposed is saying that he wants to extend most of these provisions. So, like, that's one of the first things that they're supposed to look at doing. when they start focusing on the tax changes is to extend all those things that I just mentioned were gonna go away. Whether that happens or not, I don't know. So right now, those are set to expire at the end of 2025, but it's potential that they put all this back in place. The one that might be different is that state and local tax. There's a lot of people that want them to keep that limit, because most of the time that benefits people with the higher incomes, and they think, and it can be pretty significant, so they want to keep that $10,000 cap. So we don't know though on that part. Trump has mentioned wanting to reinstate the 100% bonus depreciation that we talked about going down. Right now it's 60% for 2024. He wants to bring it back to the 100% bonus depreciation and allow full expensing of those research and development costs that we just talked about. This is one you probably heard on the news. He wants to eliminate taxes on Social Security benefits.
Yes.
And so right now you are already, depending on your income, may or may not have to pay tax on the Social Security benefits. It's just basically, it's kind of like a calculation based on what your income is. But he's just saying he wants it to never be taxable no matter what for the Social Security benefits. And this one is one that sounds cool, but when you try to think about how they're going to implement it, it seems like it will be complicated, is to exclude tips and overtime earnings from your taxable income. So if your tips just won't be taxable, overtime income won't be taxable. What a lot of people imagine is people trying to manipulate the way they do their pay structure to make sure as much as considered overtime or tips and stuff that they can. So they're going to put that in, they're going to have to put in a lot of rules, which is just going to...
The caveat still, it would be subject to FICA, still payroll
And
tax?
so
Just that it just won't be on your tax, your personal income tax.
I had a question about that. So the employer would still be
I think the employer and the
responsible for paying the,
We think so.
Yeah,
but
yeah, we don't
it would
know.
all, they're going to have to come out whenever they do this with a full set of rules about it. Next year, like I said, if they follow this, a lot of these changes are probably going to happen, maybe not all of them, towards the end of this year. Maybe the third quarter or fourth quarter, we'll start to hear more about it. They're going to have to probably do the tax bill as part of like the reconciliation process when they're trying to do the budget. So they do it that way, so they don't have to get a 60% vote in the Senate. They can just get a majority of, just need the 51 votes or whatever to get there. And so in order to do that, they have to make the bill balance, and so they have to do a lot of stuff with it. It'll probably be in the third quarter, so we'll start to hear more definitive what their plans are and some of this stuff. And tariffs, and he's already, and you can, if you've been following, he's already been imposing tariffs on a lot of the different imports, different percentages. I saw something about steel the other day, 25% tariff, aluminum. He's done stuff with Canada and Mexico. He's already put stuff in. He renamed the Gulf of Mexico for some reason.
Rename.
Okay.
Yeah.
Let's see.
That's real important.
Alright. Future tax output. So that's kind of stuff that's been put out there. Who knows when they get to the actual process of doing the bill and trying to get it to work, I'm sure there'll be new things we never even heard about in there, and there might be some of this that didn't get included that they've been talking about now. But this is just what they've openly discussed and what's kind of out there right now. So next year we might be coming here and we might be talking about all different stuff, who knows. But I do think the most likely thing that will happen is them trying to extend the tax cuts and job tax stuff. I do think there's a good percentage chance of that actually happening.
My opinion on that 10,000 cap, I think that's gonna go away. I think that's kind of their peace offering to the other side to say, hey, if we allow this part to go away, because if you think about blue states, they have a lot of property taxes, and they would want that they wouldn't want that $10,000 limit. So I think that might be a way to get a peace offering.
And so this is the last thing I want to talk about is some other stuff that they've been doing. They put a hiring freeze and an indefinite suspension on hiring until it's deemed in the national interest. 1,000+ job offers rescinded for roll start dates after February 8th. I did say the seasonal staff that they've already hired for tax season is going to stay and should mitigate the immediate tax season delays. I know I can't remember how many they said it was. They offered basically that 8-month severance package to all the employees, and there was like maybe 10,000 IRS agents that took it. So I'll be honest with y'all, from our end already, even with however many employees they had at that point, it's been the worst it's ever been at the IRS as far as response times, then losing tax returns, not processing tax returns. It makes it sound like we're making up stuff to clients sometimes because it sounds so unreal. Like, yeah, no, they just lost that tax return. We have proof that they received it, but they don't know where it's at. And then it's still like they still make it our responsibility. We gotta resend it to them. We gotta tell them what, if there's interest on it. We gotta tell them that part. It's just getting through to the IRS. If we don't call them at 7 in the morning, we may not even get through to them. If you call in the middle of the day, it usually tells you we have so many callers. We need to call back in later. So that's how it is right
Unless
now.
you owe money, then they're all over.
I'm sure that.
You know?
I'll never call up.
If you owe money, they're all over.
If you get someone competent enough to understand their own code, they might not.
I was on the phone with them for our business, and I waited like 39 minutes to talk to someone, and then when I talked to her, and she says, well, you need to talk to your tax professional, and I'm like, I'm asking you what you manage, your stuff.
Right.
We can't tell you that. That's very much.
Call it 3 times, you get 3 answers.
Right.
Yeah.
Yes. You don't want the first one, and then they put you on hold and drop the call.
It's like, why do you call?
It's crazy. I had one client, this is weird story, they sent him a notice saying he owes $1.4 million, and then they are telling him that one of the partnerships he was in got amended and it's showing that nothing, he's not in any partnerships that would ever have that much income, so it makes no sense at all. It's clearly wrong, but they will not. They keep telling us we need to prove to them that he doesn't know. Like, we don't know what you're looking at. And this is like, it's been like 6 months he just has this hanging over his head. He clearly doesn't owe it, but it's just like getting them to actually process it. It's pretty crazy. So anyways, reduced capacity for audits, maybe. So staff reallocations, IRS is redirecting existing employees to prioritize tax return processing over audits right now. Complex audits might be deferred due to resource constraints potentially, and so it's possible they'll prioritize easier targets that they don't have to maybe go out there to. They can just send a letter to small businesses and things like that. So hopefully that's not what happens, but who knows at this point how it's going to work out. There's a lot of changes with the IRS. It was already, from me, it seemed like in pretty bad shape, and without even more employees, we'll see how it goes. But
I have a question.
Mm-hmm.
So, there was a $2,000 per home energy efficient home credit. Okay. During Trump's first term, it almost went away, but they reinstated it. Matter of fact, it was after the filing period, and we had to plan it. Okay, I think that was 2019. And then under Biden, they increased it to $2,500 a home.
Okay.
How do you see that playing out?
All I know is that they have mentioned, because if they're bringing back a lot of these other tax cuts, like I said, it's going to be part of this reconciliation process. They're going to have to either show ways that they're cutting expenses or ways that they're actually getting rid of other tax deductions. And one of the things that they talked about a lot is the green energy type of credits being stuff they're looking at targeting to get rid of to make room for whatever their new stuff is going to be. I don't know if that's all I've heard about it. That's really all speculation on that point. But he has said stuff like the energy credits and stuff are stuff that they're looking at to potentially getting rid of on some of the stuff. So that's all.
If you want to contribute to charity or church, is there a limit that you can use, and also that's for the personal. But can your business also do that?
Yes, so your business can do it if it's depending on how it's structured, your business can make the deduction. If you have a partnership or S corp where that income flows down to you, basically your business can make the deduction and it will pass that down to use on your personal return. If you have a C corporation where you're actually getting taxed at the entity level, you can take it there as well.
It's a LLC.
If you just have an LLC, you can take it, but it's still going to end up on your personal return.
Is there a limit though that it has to be so much before you can actually use it to take off?
Right, so most people we talked about, Lynn mentioned that most people end up using the standard deduction because it's like $30,000. So that's basically, you get that $30,000 deduction no matter what. But you can itemize, and you can add up all your real estate taxes, your interest, and your charitable contributions, and some other things. And if that gets above that $30,000, then you start to get benefit from it. So I would say 90% of people don't get benefit from their charitable contributions right now, unless they're making substantial ones where they have a lot of property tax and interest and other things that they're doing as well.
One thing that I learned from Len last year is that if you don't meet it, you can decide to give maybe every other year and meet it that way.
I remember that from last year.
Yeah.
Right.
That was very helpful.
Yeah.
What that was maybe at the beginning of the year, you just said, I'm gonna give all this much to my church already, and then at the end of the year, instead of contributing for the next year, you bundled it all at one time, just get over that standard deduction threshold. I have seen where we have some pretty generous clients, and they gave way in excess of what their taxable income is. And because of that, they're limited, the contributions will be carried forward. And you get to use what, 80%? Up to 80% of that carry forward per year. So,
Thank you.
did you have a question?
Yay. Great job.
We need to get a picture of you guys in your BBB caps.
Yay. That's it. Boom. Oh,
Disclaimer.
All right, all that.
Disclaimer, there you go.
So interesting.